With the Federal Reserve keeping interest rates lower for longer, what should you be doing with your bond portfolio? I'm joined now by Ann Walsh, Assistant Chief Investment Officer for Fixed Income at Guggenheim Partners. So Ann, Guggenheim is running $150 billion worth of bonds in your management, so you guys are the right people to talk about this subject. So we know that bond yields and prices move in opposite directions, and with the Fed keeping rates lower for longer, and of course that's the message we got last week from the Fed's statement and guidance, wouldn't that be a good thing for bonds?
Well, it certainly is a good thing for bond issuers in terms of their ability to issue bonds at low yields. It's a little bit more challenging for savers and investors. Generally speaking, you're right, bond prices will continue to appreciate, and as rates continue to decline, we'll see that. But there's a lot of challenge for pension plans and other institutions to try and make yield in this particular environment. So they have to become very creative in the space and in their fixed income investments.
Although when we talk about a rate hike, we're talking about a very small increase, right? 25 basis points. Do you see the next one coming in December? And also talk about your outlook for 2017.
Sure. So there's still a good chance that they're going to raise rates, the Fed's going to raise rates in December. They've certainly signaled that they want to, and frankly, I think it's a little bit in their DNA that they want to raise rates and quote-unquote normalize rates. Having said that, 25 basis points would definitely be a very strong signal to the market right now. And our view for 2017 is that they will, once they start, they will continue to try and raise rates. However, unlike past periods of time, we do not think that they will raise rates very far. What is called the terminal rate of interest rates, we think will be lower than in past cycles. So not so high as it used to be.
So now that we have your outlook as an investor, is there anything I should be doing with that information in mind as a bond investor?
Sure. I think that bond investors need to be thinking about managing their portfolio in light of what will come, not necessarily what has already happened. Forward-looking is very important. Let me see if I can break down some investment statistics for you. Right now, the fixed income markets in the U.S. has about $37 trillion of fixed income assets available. About half of that appears, actually less than half of that appears in the Barclays Agg. Investors should be considering the totality of their investment opportunity and looking to invest in areas where they can win even if interest rates were to go up as the Fed raises the Fed funds rate, and manage against the future change of yield curve shape in the future as well, resulting from that activity.
All right, before we run out of time, let me just shift to a more broader perspective. Of course, we're seeing negative yields and global sovereign debt at $13 trillion worth of negative yields. So what does that mean for the bond market? Even if you don't hold a Japanese or German government bond, it still has implications for the rest of the market.
Absolutely. It means non-U.S. investors who are having to deal with those negative yields are coming to the U.S. and investing in our market. Again, a plus for investors in bonds here in the U.S. And again, going to that sort of non-indexed sector of the market where we play in our actively managed funds, there's a lot of value opportunity for investors today.
All right, Ann, we'll leave it there. Ann Walsh from Guggenheim Partners, thank you for coming by.
Thank you very much, Scott.
I'm Scott Gamm, and you're watching The Street.